Most investors never build real wealth, not because they're unlucky, but because they interrupt compounding at the exact moment it starts working. Warren Buffett didn't become Buffett by picking the perfect stocks. He became Buffett by refusing to break the compounding machine once it started turning. Compounding is simple. Money earns money, and that money earns more money. But the simplicity hides a brutal truth. Compounding only works for the investor who can stay out of their own way. Buffett mastered that discipline long before he mastered anything else. He started with small amounts, tiny amounts, but he treated every dollar like a worker on a mission. If a dollar could earn a few cents, and those cents could earn more cents, then time became the most powerful force in his portfolio. Not predictions, not timing, time. The first tactical rule is this: maximize the reliability of your compounding rate. Buffett didn't chase the highest return. He chased the return he could count on. He looked for businesses that grew steadily, predictably, and quietly, the kind of companies that compound even when nobody's paying attention. He targeted businesses with durable advantages, strong brands, loyal customers, products people buy without thinking. These companies don't need perfect conditions. They just need time. And time is the one variable most investors underestimate. But here's the part most people miss. Compounding doesn't fail because of bad stocks. It fails because of friction. Friction is the silent killer. Frequent trading, emotional decisions, high fees, chasing trends, reacting to headlines. Every interruption resets the clock. Every distraction steals from your future self. That's why Buffett avoided complexity. If he couldn't explain how a company made money, he walked away. Complexity creates friction. Simplicity compounds. If you can't understand the business, you can't understand the compounding. And if you can't understand the compounding, you're not investing, you're guessing. The second tactical rule: protect your downside. Compounding only works when you survive. Buffett avoided companies with heavy debt, unstable earnings, or fragile business models. He wasn't afraid of slow growth. He was afraid of permanent loss. Because here's the math. A portfolio that avoids catastrophic losses compounds faster than a portfolio that swings for home runs. You don't need perfection. You need durability. You need to stay in the game long enough for compounding to reveal its power. The third tactical rule: let winners run. Most investors sell their best ideas too early. They take profits the moment a stock rises, but they hold on to losers hoping they'll recover. Buffett flipped the script. A great business compounds long before the stock price reflects it. The market catches up eventually. Selling early interrupts the engine just when it's gaining momentum. Buffett didn't hold winners out of loyalty. He held them because the math demanded it. And this is where behavior becomes the real battleground. The market will test your patience. It will tempt you with shortcuts. It will punish you for being early and punish you for being late. But if the underlying business is still compounding, the noise doesn't matter. This is why Buffett built Berkshire Hathaway into a compounding machine. He reinvested profits into more businesses that generated more profits. Each acquisition added another engine. Each engine fed the next. It wasn't complicated. It was disciplined. Buffett didn't rely on predictions. He relied on patterns. Strong businesses stay strong. Weak businesses stay weak. Compounding rewards the investor who can tell the difference. The strategy wasn't flashy. It was repeatable. So here's the tactical blueprint. Find understandable businesses with durable advantages. Avoid friction. Protect your downside, and let your winners run long enough for compounding to do the heavy lifting. Compounding isn't a secret. It's a habit. And once you build your portfolio around that habit, the results take care of themselves. Not through luck, but through discipline. What's the one company in your portfolio that you believe can compound for the next decade? Share it in the comments. Your ideas shape what I explore on this channel. Thanks for watching. Stay curious and keep building your own common sense playbook.